Welcome to Powerful Tax Strategies for Real Estate Investors that will save you thousands. This is Al Aiello, and I want to thank you for having me on the presentation. Let's get right to it. First, let's eliminate some misconceptions about tax reduction planning. And by the way, I'll tell you a bit about myself shortly, but let's get to it here. Here's a question. If you are a beginner in real estate, you should not have to worry about tax planning. True or false? So false. Beginning real estate investors typically make several costly tax blunders. Here are typical startup expenses for beginners: education, auto, travel, office, all these fees, others. These could all add up. The biggest blunder, deducting these startup expenses, often with no income, with a naked loss, which IRS doesn't like, on highly audited IRS schedules, with IRS disallowing the expenses, ending up in lost tax savings, interest, penalties, legal fees, time, and aggravation, and maybe even discouraging the beginner from ever getting started. You don't need that. You know, if you do that, you might as well write a note on your tax return. Dear IRS, please audit me ASAP, the sooner the better. Now, you don't want that. Another beginner blunder is falling into the costly dealer trap when flipping properties. We're going to teach you total dealer avoidance where this doesn't happen. Many veteran investors also make the same expensive mistakes. If you are not high income or showing losses, you should not worry about tax planning. So false. You always plan. It's called loss share planning. This is not wasting deduction saving for future years when needed. You could use a NOL, net operating loss, or refunds of past paid taxes. You want to IRS audit-proof loss deductions because they don't like those losses, reducing your taxes, whatever, and other such strategies that we're going to cover. If you pay little or no taxes, it means you are not making much money. So false. With componentizing depreciation and other strategies we're going to cover, you can pay little or no taxes and keep much more of what you make, even with 6 or 7 digits income. This is it. This is the essence of this whole idea. So you could accumulate wealth much quicker. Most CPAs do not know the great money-saving strategies for real estate. Well, guys, we had to have one true in here. And that is so true because of the 80-15-5 rule. What is that? There's an 80-15-5 rule about CPAs is right there. 80% terrible, 15% pretty good, 5% superb. And then there's the 80-80 rule, meaning there's an 80% chance you got the 80 and you're in trouble. Mainly because most, and I mean most, are not real estate investors. CPAs are not familiar with the proven, documented real estate tax saving strategies that will be covered in this presentation. Yet a lot of them will still sock you with high fees for bad, costly advice and doing a lousy job. There is the problem of different types of taxes eating up your income. Ordinary income taxes, capital gain taxes, recapture taxes, self-employment taxes, AMT taxes, Medicare taxes, other taxes. I mean, these are taxes that can be converted into savings that you can invest in real estate, an IRA, your lifestyle, whatever, because saving money is like making money. There is the problem of an increased number of IRS audits. That means lost tax savings, interest, penalties, legal fees, time, and aggravation. There is the problem of bad, costly advice from inept CPAs to cost you more than the IRS. I will educate you with solutions to these problems and even more. And my purpose here is to educate you so you are informed with the best money-saving tax strategies for real estate. You don't have to know the detail or do the detail, be a CPA, but just know the overall strategies. You want to become an educated entrepreneur. Like that? Okay, great. By the way, all real estate investors will benefit with this training. Beginners, veterans, full-time, part-time, wholesalers, short sellers, rehabbers, foreclosures, landlords, rental property, commercial, paper, you name it. You know, I know this from hardcore experience. The absolute best and fastest way to accumulate wealth in real estate is a portfolio of both keepers and flippers as they feed each other with money-saving benefits in so many ways. Now, I don't have time, or it's not my role right here to get into the particulars about this, but here's the point. This double play phenomena of both keepers and flippers becomes even much more exponential with tax-saving strategies we're going to cover. Dynamic money-saving action plans for both keepers and flippers. By the way, we're going to include how to get your tax returns reviewed free for potential refunds of past paid taxes, so stay in there. We're not going to be too long here. And what I'm going to teach you is foundational, meaning you do this first before anything else. And if you have not done so, do it ASAP. It's never too late. Like building a well-constructed house, the foundation is the most important part because it is not what you make, but what you will keep that will determine how fast you will accumulate wealth. Let's prove this. Take $1, double it tax-free for 20 years. How much do you think it's worth? $1,048,000, round it. Take that same dollar, tax at 35% for the same 20 years. How much do you think it's worth? $22,000. And you could prove this on a financial calculator. That's a loss of $1 million. So what we're going to cover, our focus is money. Now let me tell you a little bit about myself. I keep this brief as this is much more about you. You know, I was a real estate investor and a real estate sales agent before I became a CPA. I'm still a very active real estate investor. I have over 25 years experience as a real estate investor, real estate agent, and real estate tax strategist. When I first started as a real estate investor and real estate agent, I had a regular job with the W-2 at the end of the year, and I was tired of those withholding taxes going out the window to the government and not legally in my pocket. And like you, I found out that there was and still is an overwhelming lack of real estate tax expertise. So with the degree in accounting, I decided to do something about it. First, I got my CPA. I passed the first time. Then I obtained a master's in taxation degree, graduating with the highest honors. I was immediately hired as professor where I taught 14-week graduate semesters on corporations, on partnerships, on real estate taxation, which, by the way, was a course I created and developed, and even a mini course on asset protection. I traveled across the country to every seminar I could find on real estate tax reduction and on real estate investing. I spent thousands on this, including every book, article, publication, home study course, you name it. I started to teach tax reduction and real estate investing courses for real estate brokers and sales agents. I set up my own tax practice that specialized only in real estate and IRS representation. Now, I have since sold my practice. You know, having a real estate background first enabled me to much better understand the tax planning opportunities pertaining to real estate. I started to and still do save huge sums of taxes legally every year, protect my assets, as my thousands of students across the country also do. So how many want to hear about these tax-saving gems? All right, great. And that's just a recap of what I just told you about myself. Let's move on. All right, let's go to the first action plan strategy, and you want to avoid IRS. I mean, the first rule of tax reduction planning is don't get audited, because an audit is like a financial enema. It will drain you of your resources the way we explain. I have developed a two-wall defense against the IRS. The first one is audit proofing. These are specific Goldmine techniques I developed to reduce or even eliminate your chances of getting audited in the first place. The second wall is automatic pre-audit preparation. This is a system by automatically having the applicable tax law citations backing up your tax strategies. Everything I teach you is backed up by tax law citations. That could be the Internal Revenue Code, an IRS regulation, a tax court case, a ruling, whatever. Hey guys, these tax law sites are money-saving profit centers that give you power against the IRS. There's a lot of money buried in that Internal Revenue Code. I'm going to give you some as we go along. Many CPAs, if not most, do not know them. So write them down. And by the way, get pen and pad and focus here. Now, the benefit of the two-wall defense, you'll be worry-free in using little-known legal strategies to save you thousands every year. We're going to be talking about low-risk, high-return tax reduction strategies. Remember this, risk mitigation, profit maximization. You reduce your risk first, then you go on to profit. And that's in any endeavor, whether it be real estate investing or a business or tax reduction planning, which we're talking about here. Now, I have over 30 ways to audit-proof your return to keep the IRS out of your life. I'm going to cover some of them as we go along. So, again, hang in there, pen and pad, take notes. In fact, let's get to the first one. Get off IRS Schedule C's and E's. Schedule C is for sole proprietors. Schedule E is for rental properties. Some people get them mixed up. Why? Legally, there's no privacy. Legally, there's personal liability, and they have the highest IRS audit risk. IRS agents would rather audit these schedules than go to heaven. Now, what's the entity you want to use? You want to use an LLC partnership. Now, this is a limited liability company that you elect to be taxed as a partnership. It's one entity. So again, a limited liability company you form legally, and then you elect it with the IRS to be a partnership. And you have to understand, there are three sides to an entity. There's a legal side, a tax side, an IRS side. And you want the entity that fares the best on all three sides, and it's this entity. On the legal side, this entity, meaning the LLC partnership. On the legal side, it gives you corporate limited liability protecting your personal assets. On the tax side, it's a partnership. I know this from teaching semesters of this. The most favorable flow-through tax benefits for real estate is a partnership. And on the IRS side, it files Partnership Form 1065, which is audited much less than C's or E's or corporations. Now, you want to avoid single-member disregarded LLCs. That's where there's only one member, you. Why? Legally, there's more chance of the entity being peers, exposing your personal assets. And guess what schedules, IRS schedules, single-member LLCs file? Yes, those nasty C's or E's. Now, if you need a partner to create the partnership, a spouse can be a partner, another family member, even your own entity, like a C corporation, which could actually add more deductions as well. So these can be low percentage, like 2%, so you can still control with the 98%. So you could be the 98% partner member. These others, whether it be your spouse, other family member, or C Corp, could be the 2% member. Well, that was just an overview. I wish I could teach you more about the entities, but we need to move on. All right, let's go to our next action plan. How to create huge deductions without paying out cash, yet put cash in your pocket. Does that sound great? Well, this is something we call depreciation. And depreciation is a deduction you take, but you don't have to pay cash for it. You know, I remember when I purchased my first rental property years ago, it had a positive cash flow. So I figured when I go to do my taxes, hey, I got to pay tax on the cash flow. But after I computed the depreciation, the property had a tax loss. I used it to offset my other income and got a nice refund. So in other words, I had a tax loss on my 1040 getting a refund, but positive cash flow in my pocket. It's like 2 sets of books legally. Your 1040 tax losses equals tax savings, and more money in your pocket, positive cash flow, the eighth wonder of the world. You know, let's give an example with a $10,000 depreciation deduction and a 30% bracket. You read $3,000 in savings with no cash going out. Think what you could do with $3,000. You could turn that into $5,000, $6,000, $10,000, on and on. Now, the problem is most CPAs do not know how to dramatically increase your non-cash depreciation deductions for huge savings. Let's look at an example. Suppose you buy a rental property for $100,000. You go to the typical tax preparer. They're going to say, well, yeah, we could depreciate it, but we got to put 20% or $20,000 toward the land. No deductions there. The remaining 80% or $80,000 toward the building. This is only $2,700 straight line depreciation on the building only. We're going to show you how to dramatically increase this. And it's called componentizing or cost segregation analysis. The multi-component land residual method is my system designed to dramatically increase valuable non-cash depreciation deductions, taking componentizing or cost segregation analysis to an even higher level by allocating the property cost first to the components that give you the largest deductions down to a low or no land value. So by breaking out the property cost into these components, you're going to get much larger non-cash deductions and increase your cash flow. Let's look at the components. First component, personal property. This is written off over 5 years accelerated method, 6 times higher than the building. Accelerated means you get more deductions up front. Second component, land improvements. These are written off over 15 years accelerated, also much higher deductions. Now, land improvements are everything outside the property. Here's our schedule: curbs, fences, landscaping, pavements, parking lots, shrubbery, sidewalks, a lot of items there. 15 years versus 27.5 or 39 years. Next components are building and even other types of land improvements. These generate even more non-cash depreciation deductions and more savings. And then last, lowest residual value, even zero. The less toward land, the more toward the other depreciable components, the more savings. Now let's look versus the 2080 way, where we got $2,700 depreciation. With the multi-component land residual system, breaking out those components on that same $100,000 property, look at this. First year depreciation, $6,100, more than double the $2,700. Second year, $8,600, triple the $2,700. Similar results next 3 years. How would you like to pick up $3,000 a year for the next 5 years, total $15,000? Think what you can do with that money to increase your wealth. Now, by the way, that was only for one $100,000 property. You know, you could add zeros. If this were 10 of these properties or $1 million property, the component method would be $65,000, still more than double the conventional method. Imagine taking this non-cash deduction against your income, your other income. Let's look at an example. Suppose you have other income of $65,000. That could be W-2 income, it could be business income, flip profits, whatever. If that's taxed at 40%, that's $26,000 taxes, money down the drain. You're left over with $39,000 instead of $65,000. Going to take you a lot longer to accumulate wealth with that. But suppose we have that $65,000 component depreciation to offset that other income. Our taxable income is zero. You pocket $26,000 with no cash going out. You have the entire $65,000. This is how you get wealthier much quicker. Now, by the way, I didn't show you the Renaissance Goldmine schedule of 5-year personal property. All these items can be written off over 5 years instead of 27.5 or 39 years for much faster deductions, and we have the tax law cite in brackets after each and every item. You know, we got the appliances here, and appliances, fixtures, all kinds of items that could be written off over 5 years for huge deductions and huge savings. I'm going to show you some examples. In a rental house or apartment, kitchen cabinets, shelves, carpeting, appliances, lighting fixtures. Wait a minute now, aren't these fixtures, aren't these part of the real property? Yeah, under real property law, that may be true, but not tax law. Write this IRS regulation down. It's a golden nugget. I have it on the screen. 1.48-1C. What that regulation is saying, state law does not govern. We govern with a criteria called movability. In other words, if you could move the component without adversely affecting the building, then most likely it's personal property, eligible for the much faster deduction and savings regardless of what state law says. It's personal property. In fact, here is our Renaissance Goldmine schedule, real property components that could qualify as 5-year personal property for huge savings via movability, a partial list. Look at this. Walls, shelving, self-storage, all these items, and the tax law sites are on the right, and other such components, even a mini warehouse. Let's look at some actual case studies. Ron Knoll, CPA from Malvern, PA, years ago, he renovated his commercial offices. Now, in the process, he converted the interior walls into movable walls to expand or reduce unit sizes so he can increase his tenant markets, small and large. Smart idea, but there's a bonus here. He gets a 5-year deduction versus 39 years. Let's get the money. Bottom line, over $5,000 savings every year. Next 5 years, total $25,000. Think what you could do with that kind of savings. Plus, he increased the value of the property with an increased rental market. This is a perfect example of combining money-making investment marketing strategies with money-saving tax strategies into a gold mine. Here's another one. Angelo Guerra, He needed deductions, the savings for his four girls in college. So he was using this as a college fund, the tax savings. Watch this. His CPA of 25 years, never heard of componentizing. And on top of that, refused to assist with it. So what do you think Angelo did? He got rid of the knucklehead. Let's stop these inept knuckleheads from getting in our way for our family's financial future. So Angelo, even though he had the CPA for 25 years, fired him. Angelo did the componentizing himself using the Renaissance Goldmine multi-component land residual system. Very good, Angelo. Money-saving result, well, saved him $20,000 in the first year and thereafter, which helped him with his daughter's college education and got rid of a loser CPA. By the way, these are real unsolicited documented testimonials. Almost $20,000. The item was componentizing. Based with the info from you, I proceed to request my CPA of almost 25 years to use this method, and then he elected to obtain a letter from the IRS stating that your method was an acceptable way of calculating the depreciation, and it is. By the way, that's $20,000 a year. If you invest that at 10% next 10 years, that accumulates to over $318,000. Knowing the tax law makes you wealthy, that's why I want you to become an informed entrepreneur, an educated entrepreneur, because most CPAs don't know this. Now, besides the huge increase in cash flow, there is even more to the miracle of componentizing. Let's look at it. You take the deductions up front, no cash out. Pocket the cash savings, yet pay none of it back, no recapture, with a tax-free exit strategy such as a 1031 exchange. And this is the magical power of the real estate tax shelter. Get it up front, but don't pay it back. But you have to have the right system to do it and benefit. Componentizing benefits all types of investment properties, small, large, rental houses, commercial. Look at this. Dear Al, using componentizing, I already saved $2,000 on only a $30,000 property, my first deal. A lot of so-called experts will tell you, well, this is only worth it on $1 million property. They're wrong. And this is from Jim, who, by the way, I helped get into real estate investing. If you miss componentizing, yes, you could go back even beyond the 3 years to catch up the missed depreciation and savings to get a check all in one lump sum. Done right, it does not increase your chances of an audit at all. It is perfectly legal. With the right system, you could easily do the componentizing yourself without having to throw away thousands to some so-called expert who probably doesn't know it anyway. So let's recap the Goldmine componentizing. It increases your cash flow by thousands. You do not have to spend a penny to get it. It's a paper deduction. You continue to keep the savings, no recapture with the tax-free exit strategy. For all types of rental properties, from a $20,000 property all the way up to millions. Done right, it does not at all increase your chances of an audit, perfectly legal. If you missed it, you could go back and get the savings. You do not have to pay thousands for someone to do it for you. In other words, you have your cake, eat it, your ice cream, eat it, your champagne, drink it, all in one premier room service deluxe package. You componentize to monetize for huge savings. How many people are liking this? Yeah, it is such a great system that I've used for so many years. Saved me and so many of my students a bundle. By the way, that was just an overview. There's even more. I could teach you about the eighth wonder of the world, componentizing, but we need to move on. My CPA will not allow me to deduct my property tax losses because I have a full-time job. Wrong. With the proper documentation, you can do anything. Now, with all of these non-cash componentizing deductions piling up, your properties are going to be showing paper tax losses that we want to use to offset your other income. And that leads us to our next action plan, to sidestep passive loss limits so you're able to fully deduct without limit property tax losses against other income. Now, if the property tax losses are over $25,000 and or your adjusted gross income is over $150,000, you have a full-time job, most CPAs will say you cannot deduct property tax losses against your other income, costing you thousands every year. And this is one of the most expensive tax traps for the uninformed, ill-advised real estate investor, is these passive losses these passive loss limitations, depriving investors the ability to currently deduct their property loss deductions against their other income, with the resultant loss of tax savings and decrease in cash flow. Yeah, eventually you could carry them over, but who knows when you'll use them. So the unfortunate result is that investors are unnecessarily overpaying thousands of dollars in taxes and losing out on the investment opportunities that can be reaped with these tax savings. Let's see, do we have a solution? How many people want unlimited deductions, big savings in your pocket? Okay, well, the Tax Act that allowed you that you could fully deduct your losses is up there on the screen. You can do it, but you have to follow the rules. Now, it was a great Tax Act, but two practical problems. There's the audit risk of fully deducting rental property tax losses in 1 year that might trigger an audit if you don't plan right. Remember, the first thing we do is reduce our risk. And then there's the record keeping of documenting so many hours every year, namely 751 hours a year, if the losses exceed $25,000 and or your AGI is over $150,000. Okay, we have a solution here, guys. We have the Renaissance Goldmine forms to document your active, not passive. Here is our weekly summary of real estate business activities. There is the IRS regulation right there up on the screen. And here, the real estate business activity is already written in there. All you have to do is put in the hours from acquisition of property, acquisition, operation, sale, exchange of property, rehab, other activities, education. It's over 100 real estate business activities. There's the authoritative support. Sign it. Put this in your backup file. You don't file this with the IRS. You put it in your backup file. And the same thing, we have our weekly summary of management activities. There's the IRS regulation right there. The management activity is already there. You just simply put in the hours, take you a couple minutes. There's the authoritative support. Sign it, date it, put it in your backup file. All in the documentation. Let's look at some actual case studies. Michael Mazzotto was a full-time air traffic controller out of LA. Is that full-time? Yes. And he wanted to fully deduct it. He just got into real estate, commercial real estate, and he wanted to fully deduct his property tax losses. His CPA, Paul, said he could not because he had a full-time job. Uh-oh, let's see what happens. But once Paul saw the documents, he said this can be done. All right. Money saving result, Michael saved $23,600 just in the first year. Hey, even if you save $2,300, it's worth it by documenting the required number of hours using the Renaissance Goldmine forms. Let's look in the trenches with an actual IRS audit. Now, I wanted to share my recent success in using your Renaissance Goldmine program to create huge tax deductions for one of my students, for one of my clients, not your student. IRS did not like us reducing our taxes, especially by this much money. Okay, so you mean the creature from the Black Lagoon, IRS, didn't like this? Well, that's too bad. Anyway, our client's tax returns were selected for audit. Uh-oh. The morning of the IRS audit, our client and I met with the IRS agent in my office. Bum, ba-dum, bum. Okay. I knew the loss deductions would not be denied because we had used Al's weekly summary of landlord management activities and weekly summary of real estate property business activities to outline the various activities our client performed. About 2 weeks later, we received bingo, no change, no taxes due, saving my client over $18,000 in taxes, interest, and penalties. Wow. Thanks so much, Paul Span, CPA. So these are real documented stories, guys. It's happening. And the lesson to be learned is that the three most powerful weapons in an IRS audit. You know, we know in real estate, location. Well, in IRS audit, it's documentation. But you got to have the right system to have the documentation. That was just an overview. I wish I could teach you more. All right, they were some keeper tax strategies we gave you. Now let's talk about giving you flipper tax selling strategies. How many do or will do these profitable sales transactions? Wholesaling, rehab, lease options, whatever. Quite a number of you. Great. Now, how many want to do these selling transactions tax-free and keep all of your profit for even more wealth? Yeah, that's all of you. Why not? Well, this leads us to our next action plan: avoid costly dealer status. When you start to sell or flip properties, many CPAs will ineptly say you're a dealer instead of the more favorable tax status as an investor. Therefore, dealer profits are drained by ordinary income taxes, self-employment taxes, alternative minimum taxes, other taxes. So dealer profits, whether received by cash or paper, I mean, even if you take back paper financing, doesn't matter, you're going to be taxed immediately, as high as 60% or more, with no tax-free exit strategies. A dealer cannot do a 1031 exchange. If a dealer, they can't use their self-directed IRA, they're still going to run into taxes. If a dealer takes back seller financing paper, they can't defer the taxes over the length of the note. They have to pay tax on the profit, even if it's mostly paper, they still got to pay out cash, even though they didn't get cash in. That's not a good situation. Being a dealer is like being condemned to hell, but we're going to save you. We have in-depth research of over 30 strategies to avoid the costly consequences of being a dealer and save tens of thousands of dollars in taxes. Now, the most powerful dealer avoidance strategy is investment intent. Write this down. Under the Supreme Court case, William Mallet, if you document your primary intent as investment intent, you're not a dealer. A Supreme Court case is the law of the land. All tax courts must abide by it, and the IRS has to get down on their knees and say, Uncle, I know this. You know, when I was in tax practice, I used in Irish representation Supreme Court case twice. One was a different issue. The other one was William Mallet. I mean, when I showed the IRS agent that Supreme Court case, I was like Van Helsing with the cross. You know, Dracula was. All right. Now, we have here our statement of investment intent based on William Mallet. For all properties that I acquire, it is my primary intent to keep the property for investment rental purposes along with long-term capital appreciation. I will only sell the property if my original primary investment intent is changed by unanticipated events generally beyond my control, such as, well, I need money, working capital, or the market changed, or there were new investment plans. And these are what we call liquidating factors, which go along with investment intent as a powerful defense. Now, there's a few up there on the screen, but there are 36 supported by tax court cases. And here you document that the flip profits generate liquidity cash for up to 10 investment necessities of the keepers. Here are 2 of those investment necessities. You need the flip profits for working capital. You have to have working capital for property investment operations, preventive maintenance, and all that. Or you could use the resale profits to modernize the keepers for more market appeal, better residents, more income, more long-term investment wealth. Remember, the flippers feed the keepers. That's what we're talking about here. The tax-saving result of my 2-part statement of investment intent: you're an investor, not a dealer. Write this down, because you are using the resale profits for investment purposes, as these flips are non-dealer investment transactions. Per the Supreme Court case, William Mallet, and 36 tax court cases. You save thousands in all these types, tens of thousands in all these types of taxes. The 2-part statement of investment intent, put it in your LLC operating agreement, sign it, notarize it, order-proof your return against the IRS. It'll be absolute kryptonite. How many people want to do this? Okay. Let's look at some actual case studies here. Now, John Burley, international speaker, great guy, and full-time real estate investor from Phoenix, Arizona, he sold 260 houses. This guy a hitter, heavy hitter, 260 houses in 1 year on land sale contracts. Now, a land sale contract is a form of seller take-back financing where the seller holds the deed. The buyer gets what they call equitable ownership. Now, I don't have time to get into all that, but it's a form of seller financing. Now, if John, what he did is he got some money down and he creatively took the rest back in paper, sold these houses fast. But if he's a dealer, he's going to pay taxes on everything, even the money he didn't get. Mainly because John admittedly used high audit IRS forms, he got an invitation he didn't want, a notice of examination from the IRS. Uh-oh. John used the investment intent defense, William Mallett's Supreme Court case, and other tax law sites, and after tough, hard arguing, won his battle as being an investor, not a dealer, with 260 houses sold in 1 year, when many inept CPAs will say it takes 5 properties. There's no set number. You just got to document it the way John did. The money-saving result, John saved over $200,000 in taxes, plus interest and penalties. Hey, I'll take $20,000. I'll take $2,000. Here's another problem scenario. Pat and his wife, Lynn, in the previous tax year, just started to get into real estate. Beginners. Remember I told you about those beginner blunders? Well, they sold 5 properties that first year. Now, think about this. John sold 260. These guys sold 5. Well, here's what happened. Typically, their incompetent tax preparer tagged them as dealers and was going to report the property sales on the highly audited and highly taxed IRS Schedule C, the worst possible schedule. All right, the Goldmine solution. We caught this before and that tax preparer could do their damage. Eliminate Schedule C and remove the property as dealer property, replaced by the lesser audited Form 1065 partnership return. You know, Pat and his wife can be partners in an LLC partnership that we talked about. In the future, follow the Renaissance Goldmine dealer avoidance strategies, as well as the related IRS audit proofing techniques. Money-saving results. We established Pat as an investor, not a dealer. Substantially reduces chance by about 400% from being audited with no Schedule C. Saved him fees and poor advice by eliminating his idiot tax preparer, and saved him $7,500 in Schedule C self-employment taxes. That was just an overview. I'll just say this. Real estate entrepreneurs can bypass being a dealer by planning in advance with dealer avoidance strategies, especially investment intent. Avoid inept advisors like the plague and go for it. All right, now, once you avoid being a dealer, now you could do some nifty tax-free exit strategies. Let's go to our next action plan. Sell properties tax-free with a 1031 exchange. You keep all of your profits for more tax-free wealth. You know, a 1031 exchange, and by the way, a 1031 exchange is this. If you're selling a property and it's got a lot of taxes on the gain, if you buy another property within certain IRS guidelines, you could avoid these taxes, capital gain taxes, depreciation recapture, AMT, and other taxes, amounting to thousands that could be invested for more income-producing property. And understand this, 1031s do not just defer taxes. You know, you hear this sometimes, you know, CPAs say this a lot. You know, 1031 exchanges, they only defer the taxes. Well, technically that's correct. Defer meaning that you may have to pay the taxes later on, maybe, but, you know, defer technically can be deceptive. Let me give an example. If you have one foot in ice and the other foot in fire, technically you're comfortable, but in between you could be dead. So let's think entrepreneurial. 1031s do not just defer taxes, but by having the interest-free and payment-free use of the tax savings, you have more buying power for the replacement property. For example, if you save $20,000 in taxes by doing a 1031, now as a 10% down payment, $20,000 empowers you to buy an additional $200,000 worth of real estate. In fact, many times, the 1031 savings combined with leverage is the difference that makes the difference in doing the deal. This is what my students do. You know, I had my own 1031 exchange intermediary years ago for 10 years, did exchanges in 41 different states. I've seen people become millionaires doing the 1031 because of that, what I just talked about, that phenomena of combining the tax savings with leverage to get more exponential into more income-producing property. Now let's go to our next action plan. Suppose you're flipping, wholesaling property. Hey, you could use a self-directed IRA where the profits are not taxed. Amass thousands of family wealth with total exponential tax-free compounding. Now, by the way, there might be limits on what you could put into an IRA as a contribution, but there is no limit as to the amount of a profit in an IRA. And if if this is a Roth IRA, you meet the requirements, and this is a Roth IRA, the profits will never be taxed, permanently tax-free. Wow. And look at this. Once you accumulate money in your IRA, you can lend money from your IRA to your own buyers. They have to be unrelated. Now, you got to watch about self-dealing and all that. But to enable them to purchase your property for cash instead of taking back paper or bank financing that we cover in Action Plan 31. A lot of great things you could do here. All right, that was just an overview on everything. I wish I could teach you more. But how many want a money-saving solution to avoid the problems of overpaying taxes, expensive IRS audits, bad, costly advice? Yes, okay. Well, my updated home study system, specifically for real estate investors, the Renaissance Goldmine of brilliant tax strategies for real estate investors. And this is a new updated system. It is a hard copy with a manual, audio CDs, CD-ROM, software forms this. Easy-to-use software system with action plans as your reference library. Now understand, this is not a cover-to-cover read. Instead, it's a reference library where you quickly select the tax-saving action plan you want just by clicking. For example, if you want to componentize and monetize, click the Action Plan 6 and dramatically increase your depreciation, deductions, and cash flow with no cash out like no other system. We cover this and show you step by step. If you want to fully deduct property losses with no limits, even with a full-time job, even if your income is over $150,000, collect the Action Plan 12 to avoid passive loss limits. Al Butler from South Jersey Investors legally saved $30,000 sidestepping IRS passive loss limits. Wow. Think what you could do with that. If you want to totally avoid being a dealer, click the Action Plan 23 and prevent 60% or more of your resale profits from being drained by all kinds of taxes. 30 proven strategies, even with a large number of flips in 1 year. Plus, we give you the right IRS form to report sales transactions so you are not a dealer with a very low audit profile. Remember, we reduce our risk first, then maximize our profits. Action Plan 31, self-directed IRAs that create tax-free wealth. 1031 exchanges, zero out taxes on the sale of properties, including quick flips with full tax law support. You can do this if you know how. We even have a way to bypass the 45, 180-day deadlines. Click the Action Plan 4 to avoid inept CPAs. But look at this. This is the wrong triple play, guys. Give you wrong costly advice, expose you to audits, and sock you with big fees. How to quickly weed out the loser CPAs or do without one and save hundreds in fees. Now, that's up to you. If you want to use a CPA, I can refer you how to get a good CPA, or if you want to do without one, you can do it that way either way. Hi, Al. I'm a CPA, and real estate investor, and I agree with everything you say about CPAs and taxes. I never knew most of what you are covering in these CDs. You are going to save me a bundle of taxes. Well, that is from Cynthia Gordon-Nick, CPA. Not only is she a smart CPA, but very lovely. Thank you, Cynthia. Loss year planning. That's an Action Plan 20. How and when not to waste valuable deductions. Bank your deductions and savings for future years when you need them instead of losing them forever. Al, so glad I got your tax system when I did. On my taxes, my former CPA would have taken about $20,000 in deductions that I did not need at all. The wasted savings would have been over $4,000. Oh, think what you can do with that. All right. With your Goldmine, I am able to use these deductions in the future when I do need them to reduce my taxes. That's Nancy. Wow. Now, as part of loss year planning, recover refunds of past paid taxes, free money, plus interest they pay you with NOL, net operating losses, your government coupon to thousands of dollars without Irish red flags. Remember, risk mitigation, profit maximization. We do both. That's an Action Plan 9. Our student Steve got a $41,000 refund of past paid taxes with an NOL carryback using the Renaissance Goldmine. The Renaissance Goldmine. Hey, folks, how would you like to get that? $41,000 of sound-free government money. Avoid depreciation recapture, even with large depreciation deductions, and continue to bank thousands. Seller financing tax strategy saves thousands both as a buyer or seller. I'll teach you seller financing, wraparound mortgages, assumptions, subject tos, land contracts. I'll teach you the investment side and then the all-important tax side, either way. More tax-saving gems that CPAs simply do not know about. Rehab tax credits to older historic properties, dollar for dollar. I mean, I have one student who got a $500,000 credit. That's like the government paying you $500,000. Now, that was a large transaction. Would you take $50,000? Would you take $5,000? We also cover low-income housing tax credits, lease option tax strategies, master lease option tax strategies, straight option tax strategies, paper, mortgages, notes, tax reduction planning, and IRS audit proofing for every type of real estate investing is covered, including high-profit, low-risk investing strategies you may not know about as well. How to reduce or eliminate alternative minimum tax, like my student Bob O'Brien saved $14,000. How an LLC partnership can empower you to take out tax-free cash versus highly taxed W-2 salaries from an S corporation. Why using an S corporation can be an expensive audit trap and tax disaster costing you thousands, despite what you've been wrongly taught. We'll tell you why and how to avoid S corporations for both flippers and keepers. When and how to use a C corporation to save you thousands with no cash outlay. When not to use would cost you with a lot of cash outlay. Much more, hundreds of tax saving strategies you can use, by the way, throughout the entire year, not just April. You will not find anywhere else. All fully supported by current tax law citations for every single strategy. By the way, the action plans also cross-reference to the special tax reduction and audit proofing forms that you've seen. The Renaissance Goldmine schedule, 5-year personal property. The 15-year land improvements. We didn't even talk about the schedule of building structural components to fully deduct building components and other components you replace for more non-cash deductions. Schedule deductible repairs will show you how to convert the system I created to systematically convert capital improvements into fully deductible repairs, or to keep them as capital improvements if you don't need the deductions. We show you always, profit years, loss years, all around. Other tax-saving forms. By the way, the forms are also sample filled in with step-by-step instructions. It's going to save you a lot of time and money, and you're not going to get them anywhere else. You're not going to get them on TurboTax, your CPA, the IRS, nowhere. Plus, 15 audio CDs, complete tracking by subtopics that cross-reference to the action plans. Plus, 3 VIP benefits exclusive for my Renaissance Goldmine students only. First benefit, email Q&A access directly to me, my address, for your real estate tax questions, and responded by me with prompt results. This is easily a $5,000 annual value. There is no question on real estate tax law that LILO cannot address. He has consequently saved many investors and landlords thousands of dollars, and that comes from Mr. Landlord Jeffrey Taylor, certainly one of the great experts on the circuit, saying that. And you can confirm that with Jeffrey. Second benefit, access to difficult to find tax experts in different specialties. You don't have to do it yourself. I have access to top CPAs, real estate tax specialists, the best, if you need them. Not just any bookkeepers, but certified bookkeepers who could do a lot of the work CPAs can do, but only for a lot less money. If you need it, if you have my system, most likely you won't get audited and use my system. But if you need it, I have the best. I got Perry Mason and Madlock for IRS audit defense. They don't lose. 1031 exchange is done right. Self-directed IRAs, LLC experts. When you combine an IRA with an LLC, it gives you a lot of great benefits. Well, I have experts who can do that at reasonable fees, and other difficult-to-find tax experts. These valuable referrals are from my Renaissance Goldmine students. How much time and effort will it take, and even money, to find them? Well, it's already done for you. Third benefit, access for your CPA's use on your behalf. Yeah, you can share it with your CPA under a special licensing agreement. You don't have to do it yourself. The total annual value of those benefits, easily $3,200. Al, I'm so impressed how quickly you respond. I'm truly glad to be your student. I have used my money wisely. God bless. That's Melanie. I sent Albert several questions, how quickly he responded. This service was worth the entire fee by itself. You're right, Ed. By the way, you'll get in when you get the system. There's a VIP Renaissance Goldmine membership certificate in the sleeve of the binder. Complete that, and you're on. Now, let me clarify this. The distinction of the Renaissance Goldmine from other courses, including my other courses, is purely a tax reduction system for the implementation and utilization of tax-saving strategies specifically for real estate investments with step-by-step instructions along with the specially designed tax reduction and order-proofing forms along with the above VIP benefits. That's the distinction. And it's this focus that makes it so powerful. All right, let's look what we have. The Renaissance Goldmine, $19.95. There is the hard physical copy you'll get. The VIP customer support membership, 1 year, $3,200. Total $51.95. Hey, if you paid that, it would be worth it. But I want everybody to have that. Cross that $51.95 out. $19.95, and it's fully deductible. And we give you the regulations. In fact, we give you a tax receipt with full tax law support and how and where to fully deduct the tuition. So you're going to save taxes right there. All right, let's go again though. Not $51.95, not $19.95, $12.95. $12.95. It's going to save you from all kinds of taxes amounting to thousands. All these ordinary income taxes, capital gain taxes, recapture taxes, all these taxes we have on the screen with little or no IRS audit risk. Remember, guys, low risk, high return. Now compare the $12.95 to the savings of the real people in the real case studies. Ron, $5,000 a year. Angelo, $20,000. Jim, $2,000. Mike, $23,600. Paul, $18,000. Paul's client. John Burley, $200,000. Pat and Lynn, $7,500. So it could be, it could be $1,000, it could be $2,000. Whatever the amount is, it's money you could reinvest to grow exponentially by putting it to use in other investment opportunities. Plus, Al Butler, $30,000, legally sidestepping IRS passive loss limits. Al is a co-founder of the South Jersey Investor Association. Got my money back in less than 30 days, just as good, maybe even better than real estate. That's Tim Van Rippen from the Mr. Landlord Cruise. Al, I saved $9,000 in taxes this year in just 3 rentals using your method. You are amazing. Vern Schmidt now does cost segregation, componentizing, consulting. He charges thousands of dollars. He loves componentizing. In fact, I hate to say this, but he had an affair with componentizing. So this stuff gets X-rated. Understand componentizing is a seductress, all right? True story. Well, no, that's not. You know what I'm talking about. We're having fun here, guys. But Vern uses this componentizing, and he uses it to charge fees for others. I have personally saved many times the cost of the course in such a short time. Elizabeth from Alabama. Real, unsolicited. Didn't even ask for these testimonials. And there's many more of them. Plus, top speakers, also successful real estate investor experts who use my systems. Right there, Jeffrey Taylor, Mr. Landlord. Dan Merrill, wholesaling. Scott Shield, commercial. Wendy Patton, lease options. Nick Sidoti, assistant housing. Dave Lindell, apartments. Bill Bronchek, who teaches at least entities, somewhat what I teach to some degree, but he loves my stuff. Peter Conte, multifamily, and others. And the late, great Ernie Kessler. When Ernie died number of years back, he was the top guru expert on the circuit. Unfortunately, we lost him, but he did love my stuff. All right, let's give you the 2 choices who you could pay. All right, you could pay the IRS thousands every year, or you could pay Al a lot less. What do you think, guys? Red and not just the IRS, but these and that CPAs who charge $1,000. They're just as bad, even worse. Or pay Al. It's a no-brainer. All right, guys. After the event, the complete package is $19.95. No, versus $12.95. And you know what? Let's go further. Cross out the $12.95. Only $9.97. You can't steal in slow motion, and it's still fully deductible. So already, just by investing in the course, you're going to save taxes right there. Nowhere else will you get there. Nowhere else will you get this system. Plus, I'm going to throw a free super bonus in. Free expert review of your last 3 years' tax returns for potential refunds of past paid taxes. $1,000 bonus. Free found money from the government. And you could go back not just for 1 year, but 3 years of refunds of past paid taxes. For missed depreciation, you could go back even more than 3 years. And these are just some students who got refunds. How would you like to be here getting this found free government money? And there are many more of these scenarios. Now, the review will be by a top CPA tax attorney, charges $300 an hour under my supervision. Takes several hours. And by the way, it includes a review of all your returns, your individual, LLC, partnership, and corporate returns. Plus, if you have not filed taxes for years, a super safe, little-known strategy you're going to love. We cover it all. Review of your entities, audit proofing, checking for costly CPA blunders, plumbers, right? No, blunders that could cause audits. Now, we can't promise this, but the potential for refunds could be good, large, even huge. It is totally confidential. The super bonus, the free tax return review, found money from the government. This is a real, actually it's really worth more than $1,000, but this is certainly $1,000 real value. Limited number, because of the high demand, this free service is going to eventually go away altogether. You know, the window of opportunity only stays open so long. So first 15 people to order will get the free tax return review. You can't steal in slow motion. And by the way, this special offer is for this event only, and it's not on any website or anywhere else. Right here, order now. The order information is there on the slide. Take advantage of this. You want to order now. And you know, let me tell you a story of Bob. Now, a few years back, Bob heard me at a Wendy patent event in Seattle, Washington. Okay, he didn't get the system. You know, he hummed and hawed and hesitated and all that. About a year and a half later, I was in San Diego doing a Peter Conti event, and Bob was there, and he was the first one to buy the system. And here is what he says. He who hesitates is lost. Al, when I did not get your tax course the first time, I learned the above the hard way, costing me $17,000 in taxes and wasted CPA fees for bad advice. And there he is right there, guys. You know, entrepreneurs do not hesitate. They act now. When they see the value far exceeds the taxable investment, they act. They know the value is more important than price. You know, it's not what you pay, but what you get. Entrepreneurs know what changes lives, and this does. So there's the order information there. Take advantage of this. You know, you will never build up a huge portfolio when you pay too much taxes. It's going to take an extra 10 to 15, 20 years. Saving taxes is foundational to wealth building. So again, the order information is on the screen. Take advantage of this. And by the way, I want to thank you very much for listening. This is Al Aiello. God bless. Thank you again.